Hi guys, in this tutorial, I'm going to demonstrate to you the calculation of example 1 under the topic of risk and return of a property investment portfolio. So now let's look at the information under this example. For this example, we have 3 market scenarios. So under each market scenario, we have a probability that this kind of market status would possibly happen, and we have each individual property's return under that market scenario. So each row on this table represents a market scenario. So now the question is how to calculate this expected return of a portfolio. In order to calculate it, we need to understand and apply the formula 2 slides before. So now let's go back to the slides over here. We do need information of the weighting of each property and the information expected return of each property. The overall formula states like the weighting of each property equals this property's value, or we can interpret as market value of this property, divided by the overall market value of this portfolio. So if this portfolio consists of 2 properties, so it will be property A's market value plus property B's market value. So now we already have the information of weighting of each property. Under example 1, the other information that we do need to calculate is expected return of each property. So how to calculate it? It's shown in the next slide. The formula is shown over here. And we can understand from this formula that expected return of each individual property is a kind of weighted average return across all the possible market scenarios. In this case, it is the expected return or weighted average return across 3 market scenarios. So, in the slides here, and we can see under each market scenario, there is a kind of term like we use probability of scenario 1 times the return of property A under that market scenario. So if we know the calculation under this scenario, we just add all the calculations for these 3 market scenarios together. So let's look at this. For this example 1, and we will do it step by step for this calculation. So now we are going to do the first step of expected return of property A equals, if you remember, that weighted average return across 3 market scenarios. So now let's look at this. The first market scenario, scenario 1, and under probability 0.2, so around 20% probability for market scenario happen. So we have 0.2, I have to go back, let me fix up this, 0.2 times 4, property A under market scenario 1, the possible return comes up is 18% in this example. So we times 18%. Then we add the next market scenario. Under market scenario 2, we have probability 0.6 for this market scenario to become true. So 0.6 times this return for property A under this market scenario. That's 12%. So let's look at 12%. Then we add the last market scenario 3. The probability for it happen is 0.2. So we plus 0.2 times property A's return under the third market scenario is 6%. So we have 6%. Then, yeah, that's the complete formula to calculate the expected return of property A. So if you input it into a calculator, and you will get the answer of 12%. So 12%, if you like to keep 2 decimal places, so 12.00%. So that's expected return of property A across 3 market scenarios. We will repeat the same process for property B. So expected return of property B under the 3 market scenario. So still, the first market scenario probability is 0.2 times, now we are looking for the return for property B, 14% under scenario 1. Then plus the second market scenario, 0.6, right? So following the same process for property A, and we will work on this. Second market scenario, property B, 10% return. So 10%, we just input over here. Then plus probability of 0.2 times property B's return under the last market scenario, 6%. So if you input the whole equation into a calculator, that following, we assume this calculator will following the scientific calculation rules. So then you will get 10% return. So if we keep 2 decimal places, so 10.00%, that's for expected return of property B. So now let's move on to the next calculation of this overall portfolio return. So now we have expected return of portfolio with A and B, right? Yeah, A and B. So now let's look at this. We need the information of weighting for each individual property. In this example, we have already been given the weighting for each individual properties. So each individual property, they constitute to half of the weighting of this portfolio, so 50%. So now we have 50% for property A's contribution to this overall portfolio return. So 50% times this property A's expected return, so 12%, as I highlighted here. So times 12%. So this term, the term over here, 50% times this 12%, just shows us the contribution from property A towards this overall portfolio return. So then we plus the contribution from property B. 50% times this property B's expected return, 10%. So then we will be expected to get 11% expected return for the overall portfolio. Okay, this is the demonstration for the calculation under example 1. Thank you for your watching.